Hi and welcome to the November buy-to-let mortgage market update. My name is Richard Purnell. I'm representing the Mortgage Home, who are your buy-to-let mortgage experts. Let's get straight into it, onto Market Watch and what's been going on in the last 4 weeks or so. Well, there's been a heck of a lot of interest, of course, in the Bank of England and the committee there that meets pretty much monthly, because there was a lot of talk about the Bank of England rate actually going up. It's been at 0.1% now since March of last year. But for a number of reasons we're not going to get into, there is upward pressure to put that rate up, which clearly would have an impact on mortgage rates. However, at the meeting last week, there's about 9 people there, and it was a 7-2 vote to keep rates the same. So not as close as you might have thought, or some of the experts might have thought about putting rates up. So are we okay then for now? Has the thought of rates going up gone away? Well, certainly not. The next meeting 16th of December. So watch that space. There may well be a different result come the December, or if not December, certainly the January meeting, that rates will increase. Now, irrespective of what happens with the Bank of England, there are other things going on in the background that may also be affecting mortgage rates. So again, I don't want to get too much into the sort of jargon or detail, but there is something called swap rates. Now, when banks have got surplus money, they lend that out to other banks. So rather than the banks going directly to the Bank of England to obtain money to lend out, they may lend it to each other, and they agree their own internal rate called a swap rate. And so those are definitely on the march upwards. So there's increasing pressure on these banks to pass on that upward increase into mortgage rates. It's highly competitive, the market at the moment, which is why the rates are still staggeringly low, but that pressure is mounting. So that leads me on to my second bullet point, that look, rates are likely to go up sooner than later. So here's a time for some action. You really want to be looking at your portfolio right now and saying, okay, what have I got on SVR rate, standard variable rate? Are they at risk? Because those rates will go up pretty much immediately that the Bank of England puts rates up. So should I be looking to fix in now while rates are still low? And here's another thing to have a look at. Now, there'll be many people who have their mortgages on a fixed rate, and their deals are going to be coming to an end at some point in the future. You'll no doubt have those recorded somewhere. Now, usually my landlords are coming to me, or even us, we're contacting landlords 2, 3, sometimes 4 months before their deal is due to end to say, look, let's have a little review of that. But given this pressure on rates increasing, there's no reason why you shouldn't look at those deals that are not finishing for 6 months, because if it's appropriate, we could be getting you a brand new fixed rate mortgage at today's rates, but yet you still can sit on your existing deal for another 6 months. So that come April, May time of next year, when your deal has come to an end, we've got your mortgage offer that was issued up to 6 months ago with those hopefully lower mortgage rates. So it's another thing to bear in mind, and we're more than happy to do that review of your portfolio, no cost, and advise you accordingly. Okay, what else has been going on? Well, of course, it's been the budget, and Rishi Sunak has been telling us about all the changes out there. And I guess as landlords, we've been holding our breath, but would you believe he's actually left us alone this time round? Well, usually we get a kicking, don't we? I think for the last 4 years, we've had quite a kicking as landlords, and all the tax changes or the legislative changes that have really turned the screw on landlords, and that seems to be costing us year on year. So, for once we can sit back and say, wow, he's actually left us alone. There was talk of stamp duty on buy-to-let and hold-to-let purchases increasing from 3 to 4%. So has that gone away? Well, maybe not. We might be kicking the can down the road, but for now, he hasn't touched it, hasn't gone there. And so we can be thankful for small mercies. Now, here's another little bit of good news. Again, could be temporary. Do you remember the rental reform white paper? Well, amongst other things, within that white paper that the government were due to be talking about anytime now, was the removal of the Section 21 no-fault eviction clause. Bad news for landlords. It means that we can no longer evict a tenant if there is no reason. Well, again, that white paper has been delayed, and that's been moved back into 2022. They're going to have another review of that to make sure that it's fair. Who knows what the outcome of that's going to be? But again, another pause. So for now, we can bask in a little bit of sunshine. Don't know how long it's lasted. It'll probably rain again at some point, but hey, let's enjoy it while it's here. But it seems to be sort of good news on that front. Finally, let's have a look at the sort of standout deals then for November. So if you guys have got a HMO, Kensington now coming out with a under 3% fixed deal for their HMOs. And that's at 75% loan to value. And by the way, these are available for limited companies as well as in personal names. So, you know, to get a limited company HMO under 3%, that's a cracking little deal. Paragon, again, another lender like Kensington, where you portfolio landlords are their bread and butter. They've also got a HMO 5-year deal at 3.15%. Again, another a good rate from Paragon. Now, Paragon have taken a bit of a left turn. Other lenders are not following yet. It's interesting to see whether they will or not. But Paragon have very recently changed their policy where they're offering the same products irrespective of the type of property. So whether it's a single self-contained unit, whether it's a HMO, whether it's a multi-unit, it's now the same rate across the board. So it's an interesting sort of change of direction for Paragon. Whether other lenders will follow suit, that would be good news because usually HMOs and multi-unit properties are charged at a higher rate. We've got TMW, the Mortgage Works. I've been looking at 80% deals. I look at them on a regular basis. It's been pretty stagnant, that part of the market for well before pre-pandemic times. There were very few lenders coming into the 80% market. Now it does feel like we're entering maybe a new chapter where lenders are feeling that property markets are settling down, property prices, they can predict it with a little bit more confidence. And so they're dipping their toe into the 80% market, which is really good news. With TMW to come out with a rate of 2.24 is frankly staggering. The typical average rates at 80%, actually over 4%. There's a few under that, but generally speaking, the clump around 4% plus. So for TMW to offer this at 2.24 is fantastic. Now, those astute amongst us will have noticed it's highlighted in green, and that's because it's only available as a green mortgage. Now, I'm teasing you a little because on the next slide, I'm going to do a little bit of focus on what green mortgages are. So stay sort of focused on that, and I'll explain in the next minute or two. Just while we're talking about the Mortgage Works, I've got to still mention it. Buy-to-let mortgage rates are under 1%. Even though rates have been at the lowest for over 300 years, seeing a buy-to-let rate under 1%. I'm still getting used to it myself as an old mortgage broker. Literally, it's only been out for the last month or two. But despite what I said on the earlier slide with the pressures for rates to go up, TMW still out there offering this deal at under 1%. However, is there such a thing as a free lunch? No, of course not. And there is a hefty 2% arrangement fee on that particular deal. So it might suit landlords with the smaller mortgages where the arrangement fee being 2% won't be too eye-watering or stick in your throat. Finally, Furnace Building Society. Don't normally talk about them too much because, to be honest, there's a lot of hoops to jump through to get an application through with Furnace. However, you know, give them their due. They've got a cracking rate if you've got a holiday let, 3.29%, pretty much market leading. Again, holiday let market has been starting to expand come sort of in the last 3 months, I would say, back end of summer, and hopefully that will continue into 2022. One point about not only this Furness deal, but a wider comment about holiday let mortgages as a whole, and particularly for you guys that are active in this market and thinking of buying as we go into winter and spring of next year to capture that holiday let market for next summer. Lenders tend to differentiate their products based on the number of bedrooms for a holiday let. So if you have 6 bedrooms or less, that's the bigger market. That's where your building societies, banks, and other lenders are chasing that business where the bedrooms are 6 and under. As soon as you are buying or want to refinance a property that's 7 bedrooms or above, then you seem to have tipped over a line here, and this goes exactly for HMOs. The same sort of rules apply. There's a feeling that it's a bit more commercially in nature. You get a lot less lenders. The planning usage might have to be different, and therefore a lot of lenders will shy away from a 7-bed property or above. There are mortgages out there for 7-bed properties and above, so don't misunderstand me. However, it's not as competitive, and this Furness mortgage, you'll not be eligible for it if you are wanting to buy one of the larger properties. Okay, I said I would talk about green mortgages. So what are they? If you've not heard of them, then you need to really pay attention for this next slide. Now, before I explain exactly what they are, I'm not here to get on my bandwagon and talk about COP26 and having to do the right thing for the planet. This is purely about genuine financial benefits to you as a landlord by understanding what green mortgages are and how you can be more energy efficient and how that translates into saved money. So before I explain a little bit more about what that is, I'll need to give you a little bit of sort of context. So just bear with me for a few seconds while we just rewind a little bit. So in 2020, the government introduced the EPC certificate ruling that said that you could only let a property if its EPC rating was between A and E. We're all familiar with that. It's been in place now for the best part of 2 years. Hopefully most of you, but there may be some landlords that have not picked up that the rules are tightening up in 2025, and it's looking highly likely that the government will tighten this particular rule, and meaning that you can only let a property if your EPC rating is A to C. Now that's a new property. If you happen to have an existing property with a tenant still in there when the calendar moves to 2025, that rule the government is currently saying will get deferred right through to 2028. So you might think, oh well, let's relax. That's quite a while away. However, here's the thing. Right now, there are over 3.2 million buy-to-let properties that have got an EPC rating of D or E. Now, if you're thinking, well, it sounds a high number, but what does that mean? 3.2 million. It's a hell of a number to get your head around. Well, let me put it another way. That means that 2 in every 3 buy-to-let properties out there right now owned by a private rental landlord, so that is you guys, 2 out of 3 of them are on a D or an E rating. Now that is staggering figures. So only 1 in 3 of our portfolios that everybody's got out there right now would pass those rules in 2025. And so I think this is why lenders are starting to introduce green mortgages more and more, because they want us guys as landlords to get on that conversation and get educated and get to understand what that means for us. And so they're pushing that debate and that conversation right now at the lenders. And this is how they're doing it. So and this is happening more and more with every lender as every month passes, that the lenders are differentiating the products that they're offering depending on your EPC rating. So yes, the rules are not changing for another 3 years. However, if you can demonstrate right now in November 21 that a property you're about to remortgage has got an A, B, or a C rating, then as a broker, I've got access to cheaper deals than if you had a D or an E rating. So why wouldn't you be proactive yourself as a landlord and not only understand which of your portfolio would be eligible, but as importantly, which of your portfolio would be currently a D or an E, and then taking some planning and action to understand what work you need to do to improve the property, to drag it to a C or above, how much is that going to cost and how are you going to finance it? Or indeed, it may well be that the cost of improving it to a C is so prohibitive that actually I need to sell it. And if you were in 2025 making that decision and you think, no, it's going to be too expensive, I'll sell. Well, can you imagine, do you think you'll get the market price of a property that's got a D or an E rating in 2025? I don't think so. I think you'll get hammered down. Whereas if right now you make that decision because you've got that information in front of you to do so, and you think, no, it's an E, it's going to be really expensive to do the property up, I think I'll sell this one. I think you will be able to sell it and not be penalised because its current rating is a D or an E. So lots to think about there. And as a broker, we are now engaging with all our landlords, all our portfolios. Templates have been updated so that we're asking our landlords to tell us what ratings they have on all their background portfolios, so we can start to have that conversation with them about what it means, how do we get it from D and an E to a C, and indeed if there's any sort of cost to that. So I've mentioned about lenders differentiating products. If you're going to a lender for a brand new mortgage and you've got an A to a C rating, then lots of those lenders are offering cheaper deals. Great news. I'm also seeing, it's a lot early days with development finance, but if there's landlords out there that are also getting involved with developments, so new build properties, maybe major conversions, perhaps going from commercial to resi for the first time, that I'm seeing, and I see this only getting more mainstream, is that development financiers, they're offering you a particular rate, particular deal for your finance, but once that conversion or that new build's completed, if you've met certain energy efficiency targets or sustainability targets, then they're offering rebates to you, hence making the whole deal that bit cheaper. And as I said, that's not going to go away. The final thing is, well, what if I've got a part of my portfolio where I'm locked into deals right now? So, you know, I'm only 1 year into a 5-year fixed rate and I can see it's on an E rating and I need to be doing some work to it. How do I release equity perhaps to finance those improvements? Well, I'm also seeing, and again, I'm sure this will become more popular, more and more lenders offering further advances at preferential rates if the purpose of the further advance is to finance things like cavity wall insulation, loft insulation, solar paneling, new energy efficient boilers, double glazing, LED lighting, you know, there's a long list, of course. So if you can demonstrate to your current lender that that's the purpose of the further advance, for those lenders that offer these differentiated further advances, you'll get better deals. So again, your broker should be aware of that and should be making that known to you. Okay, finally, I want to talk a little bit about protection, about life insurance, critical illness. You know, we're working with so many of our landlords who have quite a defined plan to get to something they call financial freedom. It's probably a phrase that a lot of you are familiar with. It's usually why you're in this game in the first place. And so financial freedom usually is achieving a certain size of portfolio that gives you a certain passive income. And that passive income, of course, by definition, is going to come in, come rain, come shine, whether you're working, whether or not. And it gives you that option then, doesn't it, to retire, to work when you want to work, to do what you want to do with your life. And that's motivating probably the vast majority of our landlords. But it comes with an additional benefit that once you've achieved financial freedom, then that portfolio has within it an inbuilt insurance guarantee, so that as I say, whether you're working or not working, whether you have an accident, whether something really hideous happens and someone passes away, and your earned income stream disappears as a result of it, then that passive income stream kicks in straight away, and it's going to pay the bills, and it's going to maintain a certain level of lifestyle. And again, that is a byproduct of aiming for and achieving financial freedom. But with most of our landlords, they're on that journey. They haven't reached financial freedom yet. And if that, for many of our landlords, that could be a 10-year plan. And let's say you're 3 years into that 10-year plan, and something bad happens now. Something comes left field, smacks your plans out of the park, and all of a sudden you're derailed, and you can no longer continue to build your portfolio and achieve your plans. So your plan's now in tatters. So if you had the right insurance policies in place, then the whole point of it then is to take you from year 3 and accelerate you right up to year 10, or whenever that final goal is, so that you immediately, your rest of your family, your spouse, your partner, your family will achieve financial freedom immediately. So you've got that passive income, because that insurance policy can clear your mortgages. So it absolutely moves you from being a part way through your plan to achieving your plan, and therefore you can keep more, if not all, of your rental income. And frankly, if something's happened to you, you know, that bad news of an accident, an illness, a critical condition, or something worse, that someone dies that was one of the money earners in the family, then frankly you will want this plan to come to fruition more than ever, so that the family that you're leaving behind have not got those financial pressures. So whilst you're on that journey, I would absolutely argue that you need to look at different insurance policies to protect your plan whilst you're on there. Once you get to it, by all means, you may want to cancel it at that point. And with these policies, they are what's called pay-as-you-go policies, so you can cancel them without any penalty at any time. If you're unsure about what that means for you, do I need it? What will it cost? How much would I need to get covered? Then we do offer a completely free independent protection review, and all the advice is free. We put everything in place at no cost to you. So in the next couple of slides, just take notes of how to get in touch to organize that free review, and then you can be reassured that either you're on the right track, or whether you need to put things in place to mitigate that risk. Just as we're coming to the end, here's a bit of an idea of some of the other services that we offer. If it's something, again, that's of interest to you, if you're looking for some advice on either bridging, or if you're just buying something to add some value and then take the profit out, by selling anything of a commercial nature. We talked a little earlier about HMOs and multi-unit properties, as well as the single self-contained mortgages, development finance, holiday let, which does include serviced accommodation within there, and auction purchases. So if you do want to have a chat about any of those areas, again, take a note, take a little screen print of this last slide, and if you then follow that link, you'll get our diary system, and you can speak to any of our lovely team. We've got a team of how many? 6 or 7 advisors that can help you on anything mortgage or protection related. Or if you're down with the kids, then as I'm not, but I'm told that squiggly thing in the right-hand corner is a QR code that you can take a photo of, and that will also take you to our diary system. So if you've enjoyed this video, you know, give it a thumbs up, put some comments on, and we can. I'll jump on there periodically and answer any questions that come up as a result. Also hit subscribe, then you can get notified when our next videos are available if it's something of interest. And remember, be educated and be successful.